2018 has already been pretty active for stocks. We've seen some impressive moves in both directions to start the year, and during this time of increased volatility, we've seen some really big name stocks lead the charge. So we're going to look at one of those leaders for our options trade of the week, Netflix. Now this has been on a tear over the last 2 months. From the opening on January 2nd to the highs in late January, it was up 50%. And over the last 2 weeks, we finally saw a decent sell-off from all-time highs of 286 down to the 236 range. However, Netflix has spent the last 4 days bouncing back to the upside, as it's now up 14% in the last week. So looking out long-term, Netflix could continue moving higher. However, we're now looking at overbought conditions in the near term. And this does not mean you want to come in and buy long put options, as overbought conditions can stay overbought longer than anyone expects. So with the expectation of price action slowing down or pulling back in the near term, we're looking to position ourselves in a trade with a neutral to bearish position. Selling a call spread is a bearish position, but it gives us the ability to also make money if price moves slightly higher or settles into a choppy stretch. So for this trade, we're looking at trading the March 2nd weekly options that has 16 days left to expiration. Using the weekly options, it allows us to take advantage of the higher time decay in the weekly options and also the higher gamma. The higher gamma means the options will react faster to changes in stock prices. So if we get a pullback lower anytime in the next 16 days, we'll be looking at a quick winner on our short call spread. So looking at the Netflix trade page, we can see that the IV percentile is 56. Anytime that number is above 50, that is giving us the go-ahead to sell premium. The higher volatility means the options prices are expensive. And this allows us to collect more premium for selling the options and will also help push our break-even point further away from the current stock price. So in doing so, it allows us to be wrong on stock direction and still make money. So we're going to be selling the 275, 277.5 call spread in the March 2 weekly options. So we're going to sell this spread for $82 per spread. So what this means is that we're selling the 275 call and buying the 277.5 call to make it a risk-defined trade. This $82 is our maximum profit potential on this trade. Now there's a $2.50 difference between the strike price on this spread. This spread is important as it will help determine our max risk on the trade. So since we're collecting 82 cents when selling the spread, we subtract the 82 from the 250 difference between the strikes. So this will give us a maximum loss of $1.68 or $168 per spread. And this 168 is also the amount of capital that's required per spread to take this trade. And our break-even point on this trade will be 275.82. And we calculate this by taking the 275 strike price of the call that we're selling and adding it to the 82 cents that we're collecting to place the trade. So we make money if Netflix moves higher, lower, or sideways, as long as the price stays below 275.82. So this gives us $7 that Netflix can move against us and we can still make money. The 275 call has a 65% chance of closing out of the money. In other words, this trade has a 65% chance of making money. Now we're also making money from time decay adding up every day and from the volatility decreasing. So this gives us 5 different ways of making money on this trade. By selling the spread, we're giving ourselves numerous ways of making money. And we don't have home run profit potential here like we would with a long call or put, but we make up for that with having 5 different ways of making money. So taking advantage of this recent volatility by placing a mix of trade types in different expiration cycles will lead to a more consistent equity curve long term. We now have a trade on that has the numbers working in our favor. We are using less than $200 of capital per spread to control 100 shares of a $200 stock. That's great leverage, which allows us to take this trade even with a small trading account. So if we continue to use the stats to our advantage, we will be able to trade with more confidence. Now let's just see if Netflix cooperates for us by moving lower over the next 16 days.